Greetings, everyone. My name is Ivan Illan. I'm the founder and chief investment officer at Aligne Wealth Advisors Investment Management, also known as AWAIM. Thank you so much for joining me today. We're going to go through our routine Q3 2024 capital markets and economic perspectives. It's something we do every single quarter around here, sharing our perspectives, highlighting different bits of research, economic data, capital market data. All of this stuff informs our decision making in our ACGM Total Portfolio Solutions suite. And we're going to cover four main areas today: the stock markets, bond markets, the real estate market, which is of particular interest to many folks nowadays, and economic data. Here are a set of disclosures. Please read them carefully and feel free to reach out if you have any questions. Also, throughout the quarter, as well as throughout the year, there's a variety of content that we do publish and share, whether it's on Twitter or our firm's Instagram account, LinkedIn, YouTube channel. There's also a podcast called Deep Economic Thoughts, also on Facebook. We'll share different highlights of research, different articles that may be written in Forbes, and it helps keep certainly our clients informed, our financial advisor network informed, and others just that have an interest in this subject matter. If you have any questions along the way, feel free to ask them. I may address them in the moment, or I may wait till the end, but please do feel free to type them into the Q&A slot in your Zoom webinar applet. Also, since I mentioned it, the ACGM Total Portfolio Solutions Suite is our separately managed account product that we offer in the marketplace. It is actually now available to LPL, hybrid, and independent RIAs through that network in the Manager Access Network. And of course, if you are a direct retail high net worth client, you're free to contact us directly to engage in a conversation or speak to your financial advisor for more information. We have fact sheets, performance history that's been independently audited as well. And we're not going to talk about any of that in this presentation today. We're just going to focus on the data and research highlights and things that are forming our decision making. Data that's coming in and research that we're doing that forms our decisions around the portfolio allocations, because all of these solutions own cash, stocks, and bonds in varying amounts throughout the business cycle. So there's a lot of tactical movement that we take throughout, which means staying on top of what's going on. So let's dive right into stock markets. In this first chart, you're going to see something that continues to mystify us in how can this persist for so long. But you'll see here for this very, very long period of time, and this is looking back at 14 years worth of the Chicago Mercantile Exchange data on S&P 500 short positions. And you can see that something happened here in around 2023. And what this was, and around the spring of 2023, was the Silicon Valley Bank default and crisis meltdown, essentially. There was a little bit of contagion with other regional banks. And look at what happened here. I mean, there have been essentially, well below 1 million short positions for a very, very long time, and almost some cyclicality to it. Almost looks like an EKG a little bit, so certainly some cyclicality. But here there was this colossal shift in short positioning, and it has been maintained ever since that period of time. So this is going on the better part of a year and a half now. One of the most important things to keep in mind when you see so many short positions out in the marketplace is that it costs money to maintain a short position. There's an expense to it, usually related to a margin debt expense. And of course, margin debt has gotten more expensive as interest rates have gone up. So this is certainly something that could be quite bullish if there's something called a short squeeze, which many of these short positions may be forced to close out at significant losses if the markets continue to hold their, certainly the S&P 500 and those, specifically those top 10 very dominant players in the S&P 500. If they continue to hold that dominance, some of these short positions may be forced to close out at pretty serious losses. So this could be bullish. It's certainly a sentiment of a high degree of bearishness, but the fact that it's remained so high for so long is quite interesting to us and something to continue to monitor and pay attention to. Also looking at the S&P 500 from a different valuation lens is the Shiller-Cape ratio. The Cape ratio is the cyclically adjusted price earnings. And so instead of just looking at price over earnings using trailing 12-month data, this looks at earnings averaged out over the past 10 years. So it really removes a lot of that cyclicality from earnings reports, which of course can vary quite a bit quarter to quarter based on different one-time charges or other types of events that may happen, especially given GAAP accounting rules. So the CAPE ratio tends to be a much smoother way to view it. And even as smooth as it has been, you can see over this 25-year quarter century worth of looking at the CAPE, you can see there's been quite a lot of variance. Coming out of the great financial crisis, it was at an absolute low in this period of time. And it's really worked its way back up to something that is kind of like some recent highs coming out of the pandemic period, and then getting back to its long-term historical average, which has been about 27.5. And now sitting at around 35. So this is generally considered kind of a lofty level, and that the value is certainly not a good buy. You know, someone who really follows the Shiller-Cape ratio would not say that the S&P 500 is a really great buy right now. And that would be primarily due to this lofty valuation. So a lot of folks are not familiar with the Shiller PE ratio or CAPE ratio. Instead, they know just the regular PE ratios that get told on the business media or something you can read in the newspaper very readily. And right now that's sitting on the S&P 500 at around 24. And the forward estimate for price earnings is at 22. So this estimate has already been factoring in some negative earning guidance, some decline in earnings within the S&P 500. And that can in fact be where some of that weakness we've been seeing in recent market history in the top 10 pricing and some declines in those semiconductor and AI related stocks. There's been quite a bit of a pullback and then some stabilization, but there's certainly some headwinds that are being seen within the S&P 500 in terms of its earnings, most of which is dominated by the top 10. And then just looking at the Federal Reserve report, this is a graphic that they provided to Congress recently, just a couple of weeks ago in their annual report, just showing where valuations are on a forward-looking basis of price earnings for the S&P 500. And you can see that the median value is 15.6. And so currently at 2417, you could say that's a bit overvalued. And even on a forward earnings standpoint, it is overvalued relative to that median value. But that median value covers a very significant period of time, and so may not be so relevant. But by any metric, it could be easy to see why many firms and many investors in the marketplace believe that the S&P 500 in its market weight index format is somewhat overvalued right now and expecting a bit of a pullback. And here's another way to look at the valuation of the S&P 500, and this is using the Buffett ratio. Buffett ratio, if you're familiar with it, is kind of a favorite for Warren Buffett. He likes to reference the market cap value of the stock market. So here we're looking at the S&P 500 in its total market cap, which right now, as of the end of June, is just shy of 29 trillion, $46 trillion. And GDP, the size of the economy on an annual basis, through the end of June on an annualized basis is 28.7 trillion. So what Warren Buffett likes to do is he takes the value of the stock market and divides it by the value of the economy, the GDP of an economy. And you get this ratio, and that's what you see down here. And the long-term average for this ratio going back a quarter century has been just under 1. And so there's been this kind of almost elegant balance between the valuation of companies and the size of the economy. And so there have been periods where there's a lot of undervaluation. Certainly, when you look at coming out of the great financial crisis, there were some great buys to be had there, sitting at almost getting down to a 0.4 value of the stock market relative to the economy. Whereas today we're sitting at 1.6 times or 160% of the value of the S&P 500 relative to the economy. And even after just coming out of the pandemic, when there was obviously a moment of a crash there, that was just getting back down to average. So since then, there was a moment of some retracement, but really it's kind of forged ahead and is really sitting at these all-time highs. So this is something very informative, certainly to us. And then looking at the S&P 500 again, and this is an index that so many people are so familiar with that it's nice to look at it from so many different angles. And here's an interesting piece that shows the top 10 by market cap in the S&P 500 versus the rest of the S&P 500. And so that greenish neon color is the rest of the S&P 500. And what it represents is the contribution to earnings per share growth, EPS growth. And the black section is looking at the top 10 and its contribution to earnings per share growth. And you can see in Q2 of 24 that certainly the top 10 have been dominant and the rest of the S&P has not been. They haven't been really contributing very much. In Q3 of 24, the expectation is to be, maybe a little bit less contribution coming from the top 10, a little bit more maybe from the rest of the 500. But then as we get into the end of the year, and I think a lot of this is coming from the expectation that the Federal Reserve is going to start lowering rates. And when that happens, that impacts so many other companies beyond the top 10 in such a significant and positive way because of their borrowing power and just decrease in debt service cost, that it really helps the bottom line quite significantly. And so you can see that reflected in the contribution to EPS growth from the rest of the market. That's estimated to begin later this year and then really continue into the first couple of quarters of 2025. So this is certainly a positive thing that would really advocate for being diversified beyond the S&P 500's top 10 concentration. And if you own the S&P 500, you essentially are exposed to that concentration risk because nearly a third of the S&P 500 is just packed into the top 10 holdings. And so when you start to see earnings now and growth earnings coming from other parts of that big index, you want to make sure you understand how you're exposed to benefit from that in your portfolio, because the basic index is not really leaning into that as it's leaning into the concentration in the top 10. And finally, another way to look at what profit recovery or earnings growth might look like for different parts of the equity markets here in the United States. The light blue is the S&P 500, and the dark blue is the small cap index represented by the S&P 600. And you can see that certainly they've had a bit of a downturn and have struggled a bit as rates have gone up, and they've had to rejigger things and recalibrate. And so CFOs at smaller cap companies have been very, very busy in figuring out how to navigate their debt service in this rising rate environment. And the idea is that not only have they been able to do that, certainly private credit has showed up in a very interesting way for many companies, as well as workouts with banks, and doing a lot of this preemptively has been quite successful. But now, as we enter into the fall, the expectation is the Federal Reserve is going to be lowering the Fed funds rate, and that's going to now have a further tailwind to these smaller cap companies, which are really quite vulnerable to interest rates. And so this is something that we see as positive. Certainly in our portfolios, we're leaning into the small and mid cap part of the US marketplace, even internationally with small caps in our portfolios, as we do see there being some great opportunities and upside there, as the S&P 500 may stagnate a bit because it has surged so very much, and its earnings really are not keeping up with that expectation of continued exponential growth. Let's take a look at the bond markets. So in sticking a little bit with the cyclically adjusted price earnings ratio, there's something fun you can do with it, which is you can flip it on its head. And when you flip the price earnings ratio, invert it, you get the earnings yield for the S&P 500. So this is looking at the S&P 500 cyclically adjusted earnings yield. And this yield is a way to make a comparison between stocks and bonds in more of an apples to apples comparison, because they're completely different things. They're totally different securities and instruments. Most people buy stocks for growth, not really for cash flow or income purposes, although a lot of them have done that because of low interest rates for so long. But that isn't actually the design of equity. The design of equity is you buy it for capital growth. And so to compare it to a yield or fixed income or bond type instrument, you get more of this fair comparison. And you can see here, going back over the past decade, that this relationship between the 5-year Treasury rate, which it's a government rate, so we consider this a risk-free rate using the 5-year bond, and you can see this little bit of an ebb and flow to the value in this blue shaded area, the yield that the 5-year Treasury has offered. And then relative to that is the earnings yield for the S&P 500, which has been relatively stable, but really downtrending somewhat recently. But here's the most interesting thing of this. The yield on a risk-free rate is just so great. If you can get close to 4% for 5 years annual, return, a yield of this relative to 2.82% from stocks, well, all of a sudden stocks start looking a lot less attractive. And so this is kind of an interesting way to look at the capital markets in more of an apples to apples comparison. You're looking at stocks as a yield instrument, not as a capital growth instrument. And maybe that informs how attractive that investment may be or not. And so looking back in time over the past quarter century, you see something kind of interesting that plays out. So if you look at between the 2000 to 2010 period, this is often referred to as the lost decade. The S&P 500 during this period of time actually had a negative rate of return for the full decade. If you don't factor in the dividends, it had maybe a smaller loss or a slight gain over that period if you include the dividends. And so something was very curious, though, at the beginning of that decade, which was the 5-year Treasury rate was significantly above the earnings yield for the S&P 500. And so and then you kind of see that they sort of flip-flop even during this course of a decade. And of course, prices were moving. This is this light blue area down here. Prices were moving during this period as well until the big crash, 08, 09, and the earnings yield spiked. So this was certainly a good reflection. If you had the stomach and the wherewithal to buy in, you would have bought in because you would have said, oh, wow, look at the earnings yield on the S&P 500. It is phenomenal. I want that. and it's, close to 8% earnings yield. Meanwhile, 5-year treasuries are down in the 1%, 2% range. So then what happened in the subsequent period of time, which we're, kind of just saw end maybe a couple of years ago, it's been a phenomenal time for equities. And all during this time for the S&P 500, it maintained an earnings yield that was greater than the 5-year treasury rate. So this was a favorable time for equities. But now we're kind of entering into this new period, a period since the Federal Reserve has begun raising rates. And now, well, maybe we're not going to see such a great time because we're seeing 5-year treasury rates at better levels than what the earnings yield is for the S&P 500. And another way to look at this is comparing the earnings yield of the S&P 500 to 10-year TIPS, the Treasury inflation protected securities. And the Economist actually estimates that we need to see share prices drop by a third to get back to long-term averages of what that spread typically is, what that gap is between the earnings yield and also TIPS. So maybe a bit dire there, but certainly an interesting thing to include in this perspective. Also looking at money supply has actually been falling a little bit, as you can see here, about down 3% over the past couple of years since the Fed has been contracting, and the Fed assets are down, total assets down about 20%. So they're doing a good job in contracting money supply. However, we're seeing that the amount of commercial loans, industrial loans available in the marketplace has been increasing. The amount of cash, physical cash that people are holding has been increasing. So this is very interesting, and probably one of the drivers why money supply has been ticking up a little bit recently, because banks are actually lending in this environment and finding people to lend to that are qualified in this environment. So that certainly lends itself more to kind of a softer landing, not such a deep, dark recessionary environment, because this is a bit of an aberration. Normally, you don't see bank lending increasing during a period of Fed tightening, of monetary policy tightening. Corporate bond spreads have continued to be very tight, with junk bonds as well as investment grade, very low spreads, which indicate a perception of very low risk in the marketplace. Bond investors not really seeing a lot of risk. And spreads are a great thing to be referencing when trying to assess what kind of risk exists in the marketplace. And further, you've seen up to downgrade ratios looking very good and trending higher. And this is something that's covering investment grade and high yield issuers. This is very good news. And so, and I started my career in the bond market, I always used to think that bond investors were a little bit more sophisticated, maybe a little bit more informed than equity investors. They had a different perspective, different view of the capital markets. If you really believe what the bond market is saying, there isn't that much serious risk that is present in our capital markets today, right now. And what is interesting, though, when you splice out junk bonds and the junk bond market, you do see that higher quality, and I put that in quotation marks, higher quality junk bonds have actually seen their spreads narrow since the Fed has begun its rate hike cycle, which is a little bit of it's like bizarre, frankly, because you would think that that is creating more risk for these firms that are already precarious in their financials. Why would higher rates make them less risky? This is strange and something that is not readily explained by history. And there are many factors that we believe contribute to this, but notice that it does not impact the very lowest grade of the junk bond market, where those spreads actually have widened since the Fed has begun its rate hike cycle. And this would be normal. Because these are the most financially delicate of all of the high yield bond markets. Let's tap on real estate for a moment. And you can see here US mortgages, which are delinquent by 90 days or more, the percentage change is about 54% increase. And this is just since the Fed has increased the interest rates in 2022. So this is certainly speaking to the fact that there is a certain segment, and that segment in our research has found that it's mostly those that are declaring unemployment as the issue for the delinquency in paying their mortgage. So the labor market is changing. It is becoming a bit weaker, and the Fed, of course, has been really driving in that direction. So we would expect them to start making some cuts this fall because things are starting to break down, and they want to be supportive of the labor markets. It's one of their stated objectives and missions between that and inflation. And just getting a sense of how dislocated the cost of homes have become in our economy relative to rent. You can see here this just incredible deviation from anything we've really seen going all the way back to the 1970s. So I think most folks realize that we do have a housing price crisis in this country. And our estimation is that this has really been significantly driven by private equity investors who have just put hundreds of billions of dollars into the residential real estate market, particularly when rates were extremely low. And that has really distorted the prices of housing in quite a significant way. Also, the absorption rate, which is also looking at month supply, you can see that as this trends higher, it indicates more of a buyer's market. And so we're seeing that trend higher across the new single family homes, across existing condos, across existing homes. So these are all trending upward, which of course indicates more favorable environment for buyers, less so for sellers. And quickly touching on some economic data here as we wrap up. If you aren't familiar with the true rate of unemployment, please take a minute to Google it, because it's something that is so relevant. People talk about income inequality, wealth inequality all the time. I don't think most people know what it even means. Well, this is a very good metric to measure what that really means in our economy. Right now, 24.5% of the labor market is considered functionally unemployed. And that is because that household does not make enough money to even meet the poverty level of income. And so imagine that. So, we're told the headline unemployment rate is 4.3%. That seems like a reasonable number. Well, when you start to look at it for, well, what are people really making, and are they, able to have ends meet? No, 24.5% are still just making enough to be at the poverty level of income, which is an abysmal number, 20-something thousand dollars. So it's totally something that has to be, if you're going to address unemployment, you have to factor in that, because that is an important aspect of consumption. Not as important, of course, of the top 20% of income earners who drive 60%, as much as 60% of consumption in this country. And maybe that's why there isn't a lot of focus on the rate of unemployment from a functional standpoint. There's been a little bit of deflation out there. So if you're in the men's suits market, or a used car or truck, you've seen those prices actually come down. So this is getting away from disinflation, where the rate of increase has been declining. This gets into the actual price of things declining. And that's a very good thing for the economy. People need a break on things. Of course, it's very limited in food. If you love bananas, great. Now you get 1.3% decline in bananas. So it is not widespread, is the point with deflation. And more importantly, just to keep in mind that just over the past 4 years, we have seen nearly 22% increase in CPI. That is a colossus of price increase. And so even when you're talking about 1% deflation, it's almost meaningless, especially when it's in a tiny part of the economy. And then, of course, this continues to be negative relative to June of 2020, a negative real household personal disposable income. So this is quite a concern, and certainly something that has contributed to the fact that credit cards have now well over $1 trillion of delinquency. So that has increased 46.5% since 2014, which is quite significant. And you saw it almost got down to zero delinquency after all those transfer payments were made from the federal government and all that money post-pandemic came into people's accounts. Well, now with inflation being so virulent over the past few years, folks have really been relying on their credit cards, and delinquency rates are now back at these all-time highs. Very, very concerning, and something that certainly the Federal Reserve is aware of. If there's a recession on the horizon, we likely may already be in a recession currently in this current quarter. You can reference unemployment rates. There's a metric out there that says if there's an increase of 0.5% in a particular month's signal on the unemployment rate, and if it's rising fast enough, then that's a recession warning. We tend to be in the camp that we're probably already in a recession right now, a fairly mild one, but that means all the more reason to be careful and cognizant of where are you exposed in your portfolios from a fixed income standpoint, but also an equity standpoint. And then very quickly looking at different banks and the health of banks. The banks are very healthy. The large, globally, systemically important banks are very well capitalized with lots of very liquid, high quality assets. So are the large, non-globally, systemically important banks. But there's a lot of other banks out there, these regional banks, for example, their assets are not so great. And so when you think about Silicon Valley Bank or Signature Bank or some of these other banks that had some issues, there may be others on the horizon. So if you have more than $250,000 as an individual in a bank, you should be careful about that, because that is beyond the guaranteed amount and the guaranteed limit. And so make sure you check your limits of FDIC coverage, and if you are over, diversify across different banks, so you are protecting your money and benefiting fully from FDIC. Also, a big change and a big backdrop is the foreign holders of federal debt. And there's a couple of notable points here. Number one, Japan is certainly a large holder of U.S. debt and continues to be. China has sold off a couple of $100 billion, but the United Kingdom's actually sold off quite a bit, even more, $300 billion that they've sold off. So, and Taiwan has entered into the top 10 of foreign holders. Maybe there's something political there that's going on. Taiwan's taking up some of the slack, perhaps, of what China has been selling off. But on the whole, the top 10 countries have declined from 63.8% of holders of federal debt down to 60.8%. So it's less of a concentration, but ultimately more debt from the government is being sold. Certainly trillions and trillions have been sold in the past few years, and that has been absorbed by the marketplace and has expanded by almost by more than $1 trillion of foreign holders. So that has been increasing. And as you think about the U.S. dollar and the strength of the U.S. dollar here in this shaded area, this shows like this very, very ever increasing, powerful, strong dollar, and relative to the 5-year Treasury rate. And as this rate declines, the anticipation would be that the U.S. dollar will also follow a bit with it, because now there's going to be other options of where to place your capital, where you can get good returns and good yields, good rates of return. You may have heard about the yen carry trade. That's been a player in some of this global upheaval and volatility. So the U.S. is not completely impervious to volatility, or certainly downside volatility. And it's been a while since it's really seen that and experienced it in any sustained way. There was a bit of a blip of it coming out after the pandemic, but that was a difficult time for so many countries. But you can also see the role of foreign institutions in buying treasuries, and how it was a big run up, and they played a very big role. And now it's been on decline. So it depends, therefore, more and more on domestic demand for treasuries. And the last item in this quarterly's perspectives presentation is, debt used to be a good thing. It used to be the government would issue debt, and that would be a very positive thing for the economy, for the electorate, because you would get more. So for every dollar that was spent in national debt, every dollar increase in national debt, you would get a return in GDP for a subsequent period of time. And this is looking at the 5-year change in US nominal GDP versus the annual change in national debt. And so, back in the 50s and the 60s, wow, I mean, you issued a dollar of debt and you were getting $8 of return in GDP, almost $10 in the 60s. And, in the early 80s and during the 80s, something really changed here. And then in the 2000s, you kind of spiked right back up, where there's some very, very good return that you were getting. But since then, it's really just been on a pretty steep decline. And so now for every dollar of debt that's issued, there's only about 60 cents, less than 60 cents of return you're getting in GDP. This is a very, very bad relationship. You don't want to be investing in things that are just providing you lower and lower returns. But it may be that we have now entered this irrevocable zone of government spending and the expectation of having any kind of GDP growth, which is maybe sad to some extent. So that is all for now. I went over a few minutes. I hope that's okay. If there are any questions, you can ask them now. And we didn't address any that were brought up during here, or we hit on them as they were being asked. And otherwise, thank you so much. Here's our contact information. Please feel free to email us if you have any follow-up questions or would like to dive into any piece of this. And we look forward to continuing the conversation. Thank you very much and have a great day.